Welcome to TDAM Talks, the podcast that brings you expert insights from TD Asset Management to help you navigate the ever-changing investment landscape. As we turn the page to 2025, this episode promises to be one of the most insightful and impactful yet. Ingrid Macintosh is sitting down with TD Asset Management's Chief Investment Officer, David Sykes, to explore the opportunities and challenges that lie ahead in the markets this year. They'll take an asset class look at investment markets and review everything from inflation trends to global growth and market volatility. This episode is your guide to understanding the forces shaping 2025 and how you can position yourself to thrive.
Hello and welcome to TDAM Talks. On the podcast today, we have one of our favorite events, our biggest podcast of the year, a look at the year ahead for 2025. And this is the podcast where we hold David accountable to give us a view and a prediction on the year ahead. And we talk about some of the things that are going to drive the market performance. David, welcome.
Thanks, Ingrid. Great to see you.
So before we start looking through the windshield, we're going to look through the rearview mirror. And as I said, we ask you to make predictions. And of course, by doing that and recording them, we have them. Last year, at the start of the year, you said you were looking forward to positive markets in equity and fixed income in sort of that 4 to 6% range. How did we do?
Well, if I was going to be self-critical, I would say I was correct on the positive, but I was definitely wrong on the magnitude. And so just to frame that, looking at North American markets, up somewhere between 25 and 30% on equities. And, Canadian fixed income was up about 5.5% and U.S. fixed income up about 3.5%. So directionally correct, but magnitude, I was way off.
So with all of that behind us, how are you feeling? That much sort of like head of steam we came into the end of the year with. How are you feeling about the year ahead?
Yeah, so a lot to talk about, and I know we will, but to sort of summarize it, I think cautiously optimistic. Earnings growth looks pretty good for North America. I think equities continue to see positive returns. Fixed income has probably had its run, and now you probably get returns in line with yields. And on the alternative side, feeling a little bit more optimistic about Canadian real estate and still continue to like infrastructure and mortgages.
Okay, so that's a good set of feelings. Now I'm going to hold you a bit more accountable. Having just released the latest wealth asset allocation view, maybe let's take it asset class by asset class. And we'll start with everybody where everyone starts. Equities, and maybe we'll start right here at home in Canada. What's your outlook for the year ahead?
Yeah, so overall, within equities, we would be positioned modestly overweight as we head into the new year. And I would say on the Canadian side, it was a very, very strong year in Canada, 20% plus returns if you include the dividend. And I would say going forward, it looks like the worst of loan losses are behind the Canadian banks. Also looks like Canadian energy companies have significant cash flow. And I would say the optimism for Canada is pretty good as we go into next year. Also in Canada's favor, relatively affordable valuations, if I can phrase it that way, trading at about 16 times forward, dividend yields around 3% at a broad-based market level. So modestly overweight the Canadian equity market as we head into the new year.
Let's travel south of the border, and we'll stick to the fundamentals for a moment because I think we'll have a separate conversation in a moment about the political landscape there. You just said 25 to 30% in 2024, but on the back of like a small handful of companies, what does the U.S. market look like for 2025?
Yeah, so in the U.S., earnings growth should be quite strong in 25, up something like 13 to 15%. The big story, obviously, in the U.S. is the Mag 7. They led the market until about July. And around that point, we saw an inflation number, a CPI number that came in a little bit weaker than expected. And you started to see a rotation out of the Mag 7 and into everything else. And so if we continue to see declines of inflation, continue to see declining rates and strong earnings, I think you could have another positive year in the United States. There's clearly going to be ups and downs, but I think a lot of people are just fixated on the fact that the market is not historically cheap, which is factually correct. That's right. But if you look at, the S&P, we're probably trading at 22 times forward. If you look at the median stock in the S&P, it's probably 19 times. Again, not super cheap, not saying this is the buying opportunity of a lifetime, but feeling good about the combination of earnings growth with a declining central bank. And so that should produce positive returns next year.
So tailwind, love it. Global. Let's go outside our borders.
Yeah, so I would just say on global, we divided up, roughly speaking, into Europe and then the rest of the world. On Europe, clearly there's some challenges with industrial growth and GDP growth. There's clearly some issues that they may face around U.S. Public policy and tariffs. So a little bit concerned about EPS growth in Europe, and so we would be modestly underweight. And then China, EM, Clearly some issues around domestic housing sector in China. Clearly, China-U.S. relations, if I can say it that way, will be challenged in the new year. And so, again, a modest underweight position there. So overall, modestly overweight equities. But again, not saying that, equities are the buy of the century, but we'd have a modest overweight position because for sure, at some point, you're going to see some choppiness in the equity markets.
Okay, let's turn to the other side of the capital structure and look at fixed income. You said a moment ago that you thought fixed income had its run. So let's talk about that. Let's talk about the sort of the yield on fixed income portfolios currently and what you see.
Yeah, so on the fixed income side overall, we would be modestly underweight. Again, we do think fixed income holds a great place in every portfolio because of its defensive characteristics and its diversification benefits. But I think it's fair to say, at least in Canada, inflation is now at the 2% range. Yields on a 5-year are probably 3%-ish. That's probably an expectation for a return as we go into next year. If you look at the United States, depending on what happens with public policy, rates may have a little bit further to go, but maybe not a ton. And so we would expect yields in the U.S. could get you 3-4%. And then as we work our way up the capital structure, if you look at investment grade, spreads are very, very tight. Again, probably not the buying opportunity of a lifetime, but U.S. corporates are very healthy. And I think it's fair to say you could expect 5-6% returns out of IG. And then if you look into high yield, again, spreads are tight. But if you look at an all-in return, sinking, high single digits for high yield as we head into next year.
Also within our toolkit has an alternatives business and specifically real estate infrastructure, mortgages, private debt. Can we talk a little bit about that sector of the investing landscape?
So alternatives, as you mentioned, has different subclasses. But if I take real estate first, I think looking forward, fair to say that we're very positively predisposed toward multi-residential and industrial and retail for that matter. The one area that has been weak has been office. You are starting to see a concerted effort by many companies and governments to have a return to office policy. And so I think we're feeling better about that. But as we look into next year, you are starting to see some positive net operating income growth. And you think you could probably expect mid-single digit returns for real estate. If I turn to our commercial mortgages, this is an area that is just incredibly steady and stable because of the short duration and income nature of the product. And it just consistently produces 4, 5, 6% returns. And I would suspect 2025 will be nothing different. So probably something in that 4% range. And then if I look at our infrastructure product, the world has such a huge demand for energy transition, for wind, for solar, for battery storage, for traditional infrastructure, ports and roads. We saw high single-digit returns this year. I suspect we'd see more of the same for next year. And then finally, rounding that out would be our private debt offering. Really like private debt for the fact that the yields and the spreads that you can get are much more favorable than the public markets. It's hard to say exactly what returns will be like there, but we would probably suspect, mid-single digits to high single digits.
Yeah, and really important for our listeners to understand, we're not saying equities or alternatives, fixed income or alternatives. It's and I think alternatives, to your point, really add that diversification and that buffer, if you will, in terms of return streams over time.
I think what people will find, and I can prove empirically, is that over time, you don't want to make all or nothing choices. It's the conversation and the debate in portfolio construction is how much, Canadian real estate, how much U.S. equity, how much Canadian fixed income. And, we're talking about shading, moving 3, 4, 5 percentage points either way. It's not an all or nothing decision. And I think what people have to remember is that you must stay invested to reap the benefits of diversification and compounding over time.
I'm going to touch on one last asset class because again, here at TD Asset Management, we added a commodities capability a couple of years ago. We've recently had Hussein and Humza on our podcast with the outlook there. Do you want to touch a little bit on the outlook for commodities for 2025?
Yeah, so commodities for me, the best part about commodities is not necessarily the return, but it's the very low to negative correlation with other asset classes. And so when those other asset classes aren't working, commodities does work. And I think it's fair to say that as we look out into 25, there has not been a lot of new mining activity. CapEx in the space has been low. And if we do get central banks around the world continuing to reduce rates and you start to see some stimulus coming out of places like China, coming out of Europe, as their economic struggles continue, it's probably a very, very positive environment for commodities. And so again, don't want to predict a commodity return, but I do think it's important to, again, as a diversifier, when nothing else is working, nice to have commodities as a stabilizer in the portfolio.
So I think the story that's really dominated the market for the last 3 years really has been the inflation, the rate environment, where are rates headed? Like, I mean, we all know directionally where they're going. What's your outlook on, how far, how fast, and what does that mean for the markets generally?
Yeah, so a lot of things have changed with the presidential election in the United States.
Oh,
And
I'm going to get to him.
so I think, obviously, if we're thinking about things like tariffs, tax cuts, potential changes to immigration, deregulation, some of those are incredibly stimulative, some of those are inflationary. I think with the best information we would have today, it does look like inflation continues a slow grind lower. You continue to see energy prices fall. WTI in North America is now somewhere between $68 and $70. You're slowly seeing shelter costs are finally starting to roll over. You're also seeing goods prices come down. Services remains a little bit elevated, but overall, that combination probably puts inflation in North America, so that's Canada, United States, somewhere in the 2 to 2.5% range. And I think then the debate will be, will the Fed be willing to accept a 2.5% inflation rate, or are they really committed at getting it to target at 2%?
You raised the subject of the election, so obviously I want to push on that a little bit further. Depending on when listeners are listening to this, but obviously in recent days, a lot of language around tariffs, particularly for Canada and China. Can we go a little bit deeper on what that does, or maybe it doesn't mean? Like, what are some of the sectors? How do we think about that realistically from an investment lens?
So it's tough to analyze something that the president-elect, sends out social media broadcasts on, because what you actually need is real policy with detail to actually analyze.
Executed. Yeah.
But I do think it's fair to say, and I think most would agree, that the president-elect views tariffs as a threat. And I think, his clear agenda is he wants to restore the industrial greatness of the United States, but he also doesn't want to necessarily hurt the consumer in the United States either. And so I suspect there'll be a more balanced approach than what the headlines would dictate. But it is fair to say that the president-elect is very unpredictable. Look, we send something like $500 to $600 billion worth of goods to the United States every year. And if there's a 25% tariff on that, that is not a good outcome for Canada. That is going to slow our economic growth considerably. But on the flip side, it probably also doesn't help American prices either. And so I do think this is more of a threat to try and again, focus on American industrial policy, make business great again in the United States. But at some point, you can do significant harm to the consumer if tariffs are in the range of a 25% against Canada, 25% against Mexico, or a 60% against China. I do think there is a bit of a line to walk there to get that balance right.
Can I scratch on that a little bit further? We think about the trade balance with Canada and the U.S. Is there specific sectors most meaningfully impacted in that scenario? Because I don't think it's equally distributed across.
No, so the vast majority of that is energy. Energy products heading to the U.S. is hugely important, and then it's autos and agriculture. And so, those prices at the pumps, prices at the showroom, that's something consumers going to feel and probably feel immediately. And so it very much is tilted toward energy, agriculture, and automotive. And I think on all of those, again, the president-elect wants to put his nation in the best negotiating position. But I think you do have to be careful because, if you get a situation of a 25% tariff, let's just say, for argument's sake, Canada retaliates and then the U.S. retaliates. Before long, consumer prices could be right back to where they were. And, sure enough, President Trump is smart enough to realize a lot of his votes were based on the fact that people were unhappy with high prices. And so he's going to have to pay attention to that as well.
It's natural resistance. What about Trump on deregulation? What kind of impact will we see from that?
So
what sectors?
Yeah. So again, the interesting thing about sort of these four main areas, whether it's tariffs, taxes, dereg, or immigration, it's one thing to say something, but it's another thing to what are you actually going to do? And so let's find out, which agencies will receive new leadership, how quickly can those agencies institute change, how many regulations will be removed for everyone added. All these things actually have to, go through Congress. Not necessarily. Trump does have a lot of executive power, but there's going to be a lot of back and forth here. And so I do think deregulation overall is going to be a positive. A lot of business confidence sentiment surveys in the U.S. say business is feeling good. Someone's talking their language finally. You're going to see real movement on this. But again, how far, how fast, what's the priority? That will be difficult to judge. But I do think it's fair to say in a dereg world, I think M&A activity will pick up considerably. And one of our strongest views is that capital markets and a lot of large institutional brokers in the United States will benefit greatly from really increased M&A activity, which has been missing for many, many years as the U.S. executive branch, at least, has been very, very punitive towards corporate America.
Because some of the things that we haven't talked about, before we have these podcasts, we talk to our listeners, we talk to advisors, people write to us about things they want to hear about. Can we touch on some of the other opportunities or themes maybe we haven't considered yet? So first of all, AI.
So in my mind, a lot of people in the market are worried that AI is a big hype and it's not real. From my reading and my talking and my studying and my understanding, AI is real and it's an amazing, amazing innovation and technology. Is it possible that we've seen some real froth and valuation in, certain semiconductors or certain industries related to power that are, a byproduct of AI? Sure. But I think at the end of the day, the one thing that I'm convinced about is that 3 to 5 to 10 years from now, AI will make productivity higher and will make corporations more profitable. And it doesn't take a lot. If you can improve your net margins, by 10, 15, 20 basis points, that's a pretty considerable improvement. And I think about a lot of the redundant, repetitive tasks that factories around the world undergo, that, financial institutions undergo. There's a lot of processes that can now be turned over to AI. And I think that's going to make a lot of productive resources able to focus on something else even more productive. And so I do think AI is real. There's been some hype for sure, but I think this is something that is a game changer, but it's not going to be done overnight. As I say, I think in the next 3 to 5 years, you'll start to see the impact.
I know that we do not partake, but what's your outlook on crypto? We've just recently seen it go through 100,000.
Crypto for me is a bit of a fascinating one. So if I'm going to analyze, a company or assets, generally speaking, those companies or assets should have revenues and expenses, and they should have net income, and they should have cash flow and free cash flow.
I sense a theme coming here.
But of course, crypto does not. And so in my mind, it's interesting that President-elect Trump is, sort of pro-crypto, because depending on the extent of tax cuts, depending on the extent of deregulation, there could be a real impact to the deficit in the United States and debt to GDP. Clearly, that's an environment, if we're assuming that debt to GDP skyrockets, that's very positive for crypto, probably not great in the confidence for the US dollar. So, in my mind, crypto is something we'll watch from the sidelines. It's not something as fundamental investors that we believe in, and it's not something that, frankly, our clients have asked us for.
Last year, we saw gold up over 30%, and we're either side of 2,700 as we're recording this. What's your outlook on gold?
So gold tends to do well, in my mind, in two scenarios. One, if there's a large geopolitical uncertainty, and, goodness knows there are several. So if we had a saber rattling between China and the United States, perhaps gold does well. But the other one is real rates. And if, the real competition for gold is the fact that if you can get a real rate of return elsewhere, then, maybe gold isn't as attractive. Real rates have come down a fair bit. So my outlook for gold would be in and around the range plus or minus 5%. But I think really gold, in my mind, is that safe haven in times of discontent. And, who knows, with his own social media channel, we may get a lot of discontent. We'll see. But, not a rip-roaring outlook for gold, but obviously want to have in your back pocket in case of some geopolitical tension.
I think you've touched on this a little bit when we talked about the increasing breadth in the marketplace, but what's your outlook for the Mag 7 going into next year?
Yeah, so this year, if you look at the market up, let's call the NASDAQ up 30%, about 2/3 of that has been multiple expansion and 1/3 of that has been earnings. And so I would not expect to see that type of multiple expansion next year for the Mag 7. I think the Mag 7, amazing companies, capital light, not a lot of debt, generating unbelievable cash flow, and returning a lot of that cash flow in some cases through dividends to shareholders. But I don't feel like you're going to get the valuation re-rate yet again. I would expect that the Mag 7 would underperform the rest of the market, that other 493 that frankly don't have the valuations that the Mag 7 has. And for once, in the last 2-3 years, it's all been the Mag 7. But now, if we get lower taxes, if we get deregulation, that's going to benefit the smaller companies. And it's probably going to be their day in the sun. And so if we could generate a little bit of earnings growth out of those companies and a little bit of multiple expansion, I do think an equal weighted basket or a basket, less tilted to the Mag 7 should outperform in 25.
So just about everything I've thrown at you today has come back with something that's biased to the upside. There's a lot of optimism, even on the heels of a really terrific 2024. What's the black swan, or what's the thing that you're worried about in 2025, good or bad?
Yeah,
What might we be missing?
So I know you've asked the one thing, but there's probably a couple. So the one thing that is possible is that the new president really does believe that tariffs is a beautiful word, and that a country or a region challenges him, and then they do a retaliatory tariff. And of course, then there's a retaliatory tariff on the retaliatory tariff. And we get into, this inflationary spiral, which will clearly not be good for growth, would not be good for rates, wouldn't be good for corporate profitability and profit growth. So that's always a concern. I don't know if that's realistic. It's a possibility. I don't know how high the probability is. The other one that, you worry a lot about is just the United States' place in the world. There's a lot of hot spots. There's a lot of things that have popped up that we just didn't expect to hear about. And so those are concerns. But on the flip side, and we tend to always look at black swans as negatives. On the flip side, what if this pro-business sentiment in the United States spreads and people start to think, maybe we should have a priority around productivity and investment, and we should have a priority about job creation. And AI does continue to expand margins, and we can put capital and human resources into more productive areas. Maybe, just maybe, earnings growth is higher than 15% and multiples stay where they are and they stay flat, and inflation does decline, and we're all shocked and surprised that we're up another 20% on the equity markets next year. Again, I don't know how high a probability you put on that, but I do think sometimes we tend to look out and just think about what are all the things that can go wrong and not think about what are the things that can go right.
So you mean instead of the Mag 7, we might have the S&P 7000? Is that what you're saying?
That would be something that I think a lot of people would say is very, very far-fetched, but I think you have to put it out there as a possibility. And at the end of the day, in my mind, what drives stock prices is the profitability of corporations. Right now, corporate profitability is very high, but I would tell you also a lot of companies are talking about the amount of money they're spending to get more productive, to drive more revenue, to drive more expense reduction and more profit. And if we saw an upside there, all it would take is China being a little bit more pro-cyclical in their own economy, a few changes in Europe, and if you had a synchronized global upswing in growth, that could really, really help profit growth over the year.
Okay, my last question, I promise. Having heard all of this, you're a listener and you're going to go out and try and make the perfect decision. What would you say to that investor who's listening to you and then trying to time the market somehow?
So I would say that if you're into speculation, feel free to go do that. But if you're into investing, which is looking to grow your money consistently year over year over year for many, many years, I really think you have to be careful about making these all or nothing decisions. Predictions for me are fun. They're relatively simple to make, but they almost never work out. And I think what does work out is this notion of diversifying across fixed income, equities, alternatives, a little bit of cash. It's about tilting and shading the portfolio with a fundamental view to how you think things will evolve. But it's not about, let's sit in cash because cash rates are 4.5% or 5%, and I'll wait it out. I mean, at the beginning of this year in the United States, everyone, myself included, thought that the Federal Reserve would cut 7 times, and there was a huge debate about whether it would be in a recession or a significant slowdown. That didn't pan out. Equities are up 30 to 35 to 40%, and people have missed out on that move. And I'm not saying you have to be 100% into that move, but you should have a diversified portfolio so that a portion of your portfolio can participate in that move. And it's just not an all or nothing. Please, please, please have a balanced view on all of these things.
Yeah, and contrary to popular belief, you don't have a crystal ball, do you? You just have years and years and years and years and years of training and really good judgment.
Well, and, right now, people are saying, well, equities is the whole show and diversification doesn't matter. Frankly, diversification wasn't your friend this year. Fixed income didn't do incredibly well and real estate didn't do incredibly well. But there will come a time when the cycle will turn and all of a sudden you'll see more modest equity returns and you really be glad you had those stabilizers. It's, again, I sound so repetitive and I apologize, but it's not the all or nothing decision you want to make. It's the steady, consistent.
I think that's a great note to end on. David, thank you. Plans for the holidays as we're recording this just before the end of the year?
Hopefully, some significant dog walking, hopefully time with my kids, and probably a fair bit of movie watching as well.
There you go. And to our listeners, hope you had a wonderful holiday season. I look forward to supporting you in the new year. And as always, you can follow us on tdassetmanagement.com or on Apple, Amazon, or Spotify. Thanks and have a great day.
Thank you for listening to TDAM Talks Podcast. If you enjoyed this episode, be sure to follow us on your favorite podcast platform and share it with friends and colleagues who love staying informed. A big thank you to our team behind the scenes, Marko Vidovic for producing the podcast, Bianca Sampson for keeping the conversation going online, George Subotic for making sure the podcast reaches you, and Anna Bita for crafting the copy that brings it all together. See you next time. The views and opinions contained herein are those of the participants and do not necessarily reflect the opinions of and are not specifically endorsed by TD Asset Management Inc. or its affiliates. This is for information purposes only and should not be construed as financial, legal, tax, or investment advice. It is not an offer to buy or sell or an endorsement, recommendation, or sponsorship of any entity or security discussed. Commissions, trailing commissions, management fees, and expenses all may be associated with fund investments. Please read the fund facts and prospectus, which contain detailed investment information before investing. Funds are not guaranteed or insured. Their values change frequently and past performance may not be repeated.